Can't believe it's the evening already. Time flies when you're having fun and learning lots. So, as Anna said, I'm a managing partner at Fabric Ventures, and I've been curating this panel here, and thrilled that you can all join us. We have a great panel now from right across the world to talk about the institutional approach to investing in this space. And that is, when we say institutional, we're talking about those investors who put money in funds who then put money behind projects predominantly, but a mixture, and sometimes a mixture of the two. So, the fabled herd of institutional investors, which I think is Mike Novogratz's favorite term for it, has been, heralded for quite some time now. And so what we want to try and do here is put some faces to those investors and understand a little bit more detail of, why they're interested in the space, whether they're being held back at this point in time or not. In a recent article, Fidelity actually said that a third of big institutions already own some crypto, quote unquote, assets. See, that's still a wide spectrum of possible types of assets. And then to understand, what the next steps are and what they're most excited about in terms of the kind of investment opportunity. So without further ado, I'll just run through the panelists that we have. So we have Marcos Veremis, who's managing director at Evanston Capital. So he was 14 years at Cambridge Associates. I believe that I got the number right. Wrote a seminal note on crypto and blockchain funds, and has been actually educated on pretty much every coast of every continent, as far as I can work out, East Coast, West Coast, UK. We have René Andres, who's the investment manager at the European Investment Fund. He's got a very broad remit and indeed experience across venture investment, so not just restricted to this space by any means, and for that matter, neither has Marcos been. Historically, he's been a consultant and an entrepreneur, and has studied venture capital, entrepreneurialism, and data science. So all the better to kind of scrutinize our performance, I guess. And then we have Colleen Sullivan, who's partner and CEO at CMT Digital, with a very distinguished legal background, and is indeed focused, specifically on this space. So to kick things off, and feel free to give a little bit of the background to how you got in the classic crypto genesis story, perhaps. What is with the institutions I said are coming? How are you thinking about the state of enthusiasm for the space from institutions, and why does that exist? And where are we in that overall cycle? Is this kind of first quarter, halfway through the game? Love to hear your thoughts. Maybe Colleen, you'd like to go first.
Sure. Yeah. So CMT Digital is a subsidiary of the CMT Group, which is a 23-year-old proprietary trading and investments firm headquartered in Chicago. So I think to your question, it depends on how you define an institution. So if we define institutions broadly to include proprietary trading firms, then I think there's significant traction at this point. Chicago, where I'm based, is pretty well known for its prop trading community. And most of the prop trading firms have been trading in the space for at least 3.5 years at this point. And part of the reason for that is we're trading our own capital. And therefore, I think we're more comfortable taking on, operational, financial, counterparty, regulatory risk than a manager managing third-party assets. And then sort of as a natural progression from our trading, most of the prop trading firms are also investing on a venture basis. Now, if you take the sort of traditional definition of an institution, as you mentioned, Fidelity says that, a third of institutions in the United States and Europe are now in the space. I think we're early, but we have significant momentum. I think that Paul Tudor Jones and Renaissance entering not long ago are, important things to keep an eye on. I was also part of a call with our OTC desk yesterday, where a large publicly traded company in the United States that's in the software business has idle cash on its balance sheet. And given the macro environment, they've decided that the best place to put that cash to work is through purchases of Bitcoin, which I found very interesting.
Very interesting. Thanks, Colleen. That's great. Marcos.
Yeah, so I define institutions, given my perspective, because as you said, Richard, I was at Cambridge Associates, and now with Evanston, and our LPs are mostly institutions, and what that means to me is endowments, pensions, potentially some large family offices. You could classify them as institutions, sovereign wealth funds, and so on. So I'll give you a very brief history of, I think, the timeline of involvement. So when I started back in 2018, formally looking at crypto, I would say the interest from these types of institutions was limited to non-existent. It was just a curiosity at the beginning of 2018 because of the bubble of 2017, and because, you know, a number of these institutions had traditional venture funds that were dabbling into crypto. So maybe a very small piece of their portfolio was there. So it was just a curiosity at that point. So we started 2.5 years ago with zero, I would say. Fast forward in the middle of 2018, you had a couple of events. You had the Andreessen Horowitz crypto fund, and you had the Paradigm, the Sequoia spin out. And that's where the first, I'd say, institutional checks to dedicated crypto managers were allocated. You know, I don't know exact numbers, but we're talking about $500 to $800 million. So I would call that phase one. I would say that after that, there was a period during which things were quiet as crypto was struggling. You know, crypto prices were going down and the industry was in a bear market. And we wrote our paper at Cambridge beginning of 2019. A few months later, Libra announced their project. And I think at that point you had phase two, what I would call phase two, where a number of other institutions, probably not the thought leaders, but smaller institutions, started also making some small allocations to the space, and in some cases in non-brand names like new crypto native funds. So where are we now? I think we've made some baby steps in terms of institutional involvement, as I defined it, you know, these endowments and pensions and so on. But we've gone a long way. And what do I mean by that? You know, institutions move in baby steps. So if we take that into account, I would say we've moved a very long way. And the other thing I would say is that I think that a lot of institutions are progressing into their research into the space, and there's a significant pipeline of them that are in various phases of their research and potentially will be allocating in the next 12 months. And finally, this environment that we're in, and Paul Tudor Jones and so on, I think could be another catalyst. So I think we'll be going into phase 3 pretty soon.
Thanks, Marcos. René.
Yes, so maybe adding to Marcus' perspective a bit, our perspective from EAF, we primarily invest in venture funds on a very large scale in Europe, doing that since over 30 years. And how do we get into this? And how do we see the institutional investor space acting? I think my view is very narrowed down to investments in very early stage blockchain-based projects, not necessarily in large market capitalized assets like Bitcoin. That's not necessarily the interest of us as an institution. And kind of when did we start looking into this? I think in 2015 we had first discussions with some GPs that were looking into the space, but that was only really a few. Then there came the kind of, you could say, ICO market popping up and the burst afterwards, where venture funds were more on an opportunistic basis looking into this. But now, since I'd say 2019, we see, I would say, a further interest in that type of investment, not necessarily on the, as I said, big market capitalized crypto assets like Ethereum or Bitcoin or Zcash or any other, more on fundamental, very early stage venture-like investments in that area. So we see interesting strategies arising and a few institutional investors moving into that space. But I would even say on the venture side, if you carve out the, I would say, you could say hedge fund strategies around that we see also around Bitcoin, other big market capitalized assets, there is not really a big institutional scene, at least in Europe, that's investing there in GPs that have a strong investment focus in the space. We see that from some generalists who do that, but from an institutional investor perspective, it's some family offices, some corporate players, some endowments here and there, but it's still fairly limited and it's fairly early days, I must say, from our view on the venture space itself.
Thank you. So maybe to tease apart that question of the hedge fund strategy versus venture capital, and back to you, Colleen, so I know you are engaged in both there. Maybe you can help us understand, what's the kind of weight of capital between those two areas, and perhaps some detail on the kind of types of strategies on the hedge fund side, because obviously that can, in many respects, vary much more than venture. And then as we sort of go back through the rest of the panel, be interesting to talk about what are the specializations or what's the capabilities that make for great managers in those respective spaces.
Yeah, so from our standpoint, we started, our investment in the space was early, just in Bitcoin, and that then turned into trading on a proprietary basis in the global spot and derivatives markets. And the arbitrage opportunity that took place in mid-2017 was really significant. And at that time, we considered setting up a formal hedge fund. We didn't do that for a couple of reasons. One, we weren't sure how long the opportunity would persist. And second, for the reason that I stated before, we were comfortable taking on the risk of trading in the markets at that time on a proprietary basis, but it really didn't feel appropriate at that time to do so for third-party assets. So, you fast forward to now, and I think that conversation is a little bit different. While we're still trading on a proprietary basis, I think that the markets have matured to a point where a hedge fund structure is appropriate for third-party capital. At that time, the arbitrage opportunity was as significant as 10% or more across various exchanges. It's now negligible because the markets have become more efficient. We've also seen tremendous growth in the last couple of years with crypto spot and futures exchanges. The challenge that I think we would have is the markets. Okay, so if you put this in perspective, the total market cap of the crypto markets are about 1/5 of the size of one US company, Apple, right? So to deploy strategies at scale, it's kind of a chicken and the egg problem. We need the markets to grow. So I think for us, that would still be a challenge. On the hedge fund side, the other issue we would have is, we would never feel comfortable holding Bitcoin outright on behalf of, investors at a 2-in-20 structure. So for us, the venture structure made more sense. And even with our venture investing, we started that on a proprietary basis too. So we started investing in the space mid-2017, and it wasn't until mid-2018 that we transferred those investments into a formal venture structure and raised third-party capital. And we also had to register with the Securities and Exchange Commission as an investment advisor. So that was, a bit of a process too. So for us at this time, managing third-party capital in a venture structure, makes a little bit more sense.
Oh, that's great. And maybe just to wrap up on that, what do you see is required from a specialization perspective, say in the venture side rather than the hedge fund side? And indeed, maybe any further comment on, the depth of the market was holding you back before, but were there other questions around? What are the other questions? Security, custody, etc. Perception.
Yeah. So let's see. So in terms of specialization as a VC in this space, there's a couple of things that come to mind. So quickly, I think, here we're building this new internet of value, which is different than the original internet of information. In building an internet of value, you're dealing with money and assets, which are highly regulated worldwide. So you draw regulatory scrutiny to building in this space. Once the Internet of Information got going, it really could rely on principles of free speech and therefore was able to scale and flourish. That's different here. If you take the US alone, a crypto startup has to deal with 50 different state regulators and the federal level, the CFTC, the SEC, FinCEN, FTC, and more. So you can't really do the Uber approach of let's break laws and ask for forgiveness second. It doesn't work in this industry. So the legal know-how, I think, is important. The other thing I'll mention quickly is, you're dealing with bearer assets, and the technology to protect those assets is really complex. So like when we started trading in 2016, there were no third-party custodians that we trusted as much as ourselves to custody digital assets. So we had to build all of that internally. And as a VC, often you're going to be dealing with tokens, which is different than traditional VC investing. And those tokens, if they're not liquid today, they will become liquid. They're going to trade on secondary markets. You may want to stake them to earn additional yield. So VCs are sort of being forced to be comfortable, with a bearer asset that is liquid, and you have to figure out staking. So I think those are a couple of areas where specialization is required.
That's super helpful. Thanks, Colleen. Maybe just continuing on that thread, either Marcos or René, who would like to pipe up.
Yeah, I mean, on the specialization side, to add some flavor to what Colleen said, which I think we also experience from an instrument perspective, from an institutional perspective, how do you value these assets? How do you deal with tokens that you receive as an institutional investor? Are very simple problems that you run into, and also how you structure that on a fund side. On top, I think when it comes to also specializations on the GP side, at least our perception is that the current ecosystem, when I talk around European startups in the space, is that it's very developer community centric. So there's a large bunch of people in Europe, typically software engineers, developers that have formed and are starting off various projects. So as a VC in the space, that's what we tend to hear from entrepreneurs and also some of our VCs, is that you require a certain, you could say, expertise, knowledge, passion around this technology in general to have a sophisticated understanding, and also around the token economics that can come with that, and various other things. So I think we would tend to say you need a certain level of motivation and technical understanding in that space to get to the interesting companies, and being able to talk with them actually on an even level. Because that's some startups are a bit frustrated by when they talk to also some bigger flagships, also across the globe, because it's a very different mindset sometimes of how these technologies work. But that's in terms of specialization. For the rest, I think I agree with Colleen. Also on our side, I can tell you a small anecdote. It's some time back we received distributions in kind as an investor in the form of tokens, and we didn't know what to do with it. So the same applies on the VC side. When you do investments, do you do soft investments? Do you do convertibles with token kickers? How is this structures and ease of the different jurisdictions? And there you run into a similar problem on the European side that I guess you run into the US as well.
Very much then, Marcos.
Yeah, so there are two questions here. I'm going to try to be brief because Colleen and René covered, a lot of that. So the first question is, what's the way to invest in this space? And what I need to stress here is that this is a very unique space in the following way. It is really venture capital, like very early stage venture capital, a new technology, but with early liquidity and sometimes in the form of tokens and other crypto assets. Of course, there are blockchain companies like Coinbase and so on with traditional equity. So given that it covers such a broad universe of securities, if you wish, from very liquid to very illiquid, there are many ways to play the space. So the question is, how do you do that? And as of now, the industry has evolved in, from the liquid side, you have the ability to buy Bitcoin yourself, and then all the way to the illiquid side, you have, the ability to invest in a venture capital firm. But there are many hedge funds that do both liquid and illiquid stuff, and there are many venture funds that do both liquid and illiquid stuff. They kind of play the whole field. I think that in the institutional world, the venture capital structure has been the more interesting one so far, because it has certain benefits versus a hedge fund structure, even with respect to liquid stuff, if you're a buy and hold long-term holder. And by that, I mean, they can draw the capital, they can average into the space. They don't need to worry about redemptions at the worst possible time. I saw a few venture funds in 2018 that actually drew capital and bought a lot of Bitcoin at 3,500, while I saw a lot of hedge funds that were holding Bitcoin and were facing massive redemptions and kind of shut down. So I would say that the venture capital structure, although not ideal in many cases, is probably the favored one in at least the world I work in, the endowment and foundations and so on. So that's one thing to note. The other thing, talking about specialization, one question I get very often from institutional investors is the following. They say, why should we be doing crypto native, crypto dedicated funds? And why shouldn't we let our venture capital funds or some of our hedge funds, like Tudor in this case, more recently, make the allocations for us? And I have a strong view on this. I believe that this is a space, particularly from the venture lens, that really requires specialization. And I do think that within a generalist structure, there are important structural barriers. Early liquidity, network participation, these were mentioned before. These are open source, really non-traditional business models. You need to be kind of fully committed to what you're doing. You need to know the developer communities think in different frameworks, have potentially different terms. And I think the evidence suggests that a lot of the partners in venture capital firms, to take venture as an example, who specialized in crypto or who were passionate about crypto, spun out. They spun out either within the same firm, as happened with Andreessen Horowitz, or they spun out and did their own firm. And then some of the generalist firms are actually allocating the crypto allocation to these specialized managers. So the evidence suggests that also that specialization is key here.
Marcus, thank you. You won't be surprised, I'm not going to argue with the conclusion that the specialization is required there by virtue of the stage and the deep technology and developer centricity and so forth. But Colleen, as Marcus said, sometimes the strategies get mixed or have been mixed. Maybe you can clarify for me, are you mixing your strategies at all, or are they entirely distinct? I think they're distinct. That's question sort of A. And question B is, just to pick up on what you previously mentioned in the context of, Paul Tudor Jones and so forth, we've got a great economic dislocation going on right now. Or at least we've had a health crisis, and we may well be moving into a more fundamental economic crisis. How big of a tailwind will that be, do you think, for kind of the proverbial, uncorrelated assets that crypto might suggest they can be?
Yeah, so on the first question, it's interesting. In our venture fund, all of our investments have been in equity or debt of operating companies in the space. We've not invested directly in any tokens. We do have investments in Polychain and Pantera. So, the 28 investments are all direct, but then we have investments with those two managers. And those were our first two investments, actually, because we did want exposure to the token investments, but we had some hesitation on the legal side, doing that directly. So our fund is really made up of all direct investments and then the Polychain and Pantera investments. So we've kept that separate. On the proprietary trading side, while the majority of our trading is in, the most liquid assets, Bitcoin and then Ethereum, we do have token investments in probably 50 different, protocols. We've done quite a bit over there, but again, we were more comfortable with the risk on the proprietary side. So we have kept that largely separate. As far as the current environment, I think if you look at the increasing global fiscal and monetary stimulus that we've seen over the last few months in connection with the pandemic, combined with what we're seeing in the United States with the Black Lives Matter movement and the changes that we need to make in this country, I really do think that should accelerate the building of this alternative financial system that's more accessible, inclusive, and not subject to the same vulnerabilities as our traditional financial system. We tend to think innovation gains traction in tough times. So I do think we'll see some acceleration that we wouldn't have seen, without the last few months.
Thank you. Thanks, Colleen. That makes a lot of sense to me, certainly. So, and René, talking of innovations, and I actually don't know to what degree you may be equipped professionally or personally or both to talk about this, but what do you feel is the nation state perspective on these new digital assets? The question of obviously sort of nation state stable coins or CBDCs or indeed the question of what's been built by Facebook and the Libra Association. Do you have any kind of just perspective to share on that?
Yeah, I mean, to us, that's a bit difficult for me to grasp, just because I mainly have a European perspective here. There are all sorts of various, I would say, political considerations on to make use of that in general, to build in regulation that allow such, let's say, projects, innovation to flourish in the European market. I'd say I would probably slightly twist your question answered a bit differently. I can mainly give some flavor on the maybe on the venture side. I think regulators and nations are more open to provide a certain flexibility to allow these new type of instruments that you're essentially investing also in such companies, because they come with certain short-term liquidity you can have, that come with certain a general token economic you can have in such investments, and to allow that freedom. And I think their regulators are open. Time will tell what will be their final standpoint. More on if you talk around stablecoin or Libra or other topics, there I can hardly make a comment on what's the, I would say, European regulator perspective. But at least on the venture side, I think they're very bullish on it, giving also the open source ecosystem you have in Europe, with various open source projects that started here 10, 20 years ago. And essentially, we are into a similar evolution, hopefully, here. And I think regulators will be, and we as EIF will be part of that, be at ease to provide here a certain level of flexibility on the venture side, at least. I cannot really much comment on the other elements.
Understood. I thought I'd try and drag you there, but I totally understand. So to kind of wrap up over the last couple of minutes here, I think one of the interesting questions that people will have is that if you had a fantasy sort of capital allocation portfolio in mind, what might that look like? So you can divide it as you want, like you talk about, I guess, between venture and hedge fund. But I mean, more interestingly, perhaps, if Marcos, if you go first, if you're advising your clients at Cambridge Associates, pick a typical client and trying to split between different fund managers, it would be a good place to park their money over the next 5 to 10 years. Can you give me a flavor of if you could just make that choice, what that would look like?
I would say there are a few venture funds that I really like. Now, they range from doing only equity, like think, exchanges and prime brokerage, all sorts of crypto businesses that involve equity and no tokens, like traditional businesses. But there are also venture funds that I really like that play kind of the whole field, even Bitcoin. They hold everything from equity to Bitcoin, and they allocate, opportunistically. So I would have a number of these managers in there that I really like, maybe 5 or 6. I would top that up as of now with a direct Bitcoin allocation, because I don't think you'd get enough Bitcoin exposure from some of these managers. You might get ETH exposure, but not enough Bitcoin exposure. And I think you've got to have a bit more Bitcoin. And then down the road, although right now it's really unscalable, and I think Colleen mentioned that, there's some potentially very interesting hedge fund types of strategies that involve arbitrage and trading and momentum types of strategies. But I would call that a totally separate animal from the buy and hold venture perspective. So I think for the next 5 to 10 years, I would try to develop a bucket that kind of plays the whole field in this, potentially in this sort of way. But I would start with a venture, because I think that's where people are more interested in. I just think that's where the asymmetry is. This potential, putting a small allocation in, but potentially having a huge payoff if this technology does reach its potential.
Got it. Appreciate that, Marcus. So very rapidly, perhaps Colleen and then René.
Sure. I mean, if this is fantasy, I think what I would do is I would find a bunch of great gamers. And I think there's so much potential in this space for NFTs and gaming and having people own their, skins and emotes and digital assets and making all these games interoperable in this metaverse environment. So that would be my fantasy venture allocation going forward in the space over the next 10 years.
Got it. Megan, agree with that. We've just done one of those. René, over to you.
Yeah, I would probably allocate everything in venture just because I think Bitcoin is definitely interesting and there are some interesting hedging strategies and arbitrage strategies you can follow. But I found the venture space more interesting and to build early stage startups, be part of that and be part also on the great evolution you can have and return you can make in these investments. I would deep dive into that in everything from picks and shovel businesses to infrastructure plays. I think there's great potential and it will play out.
Thank you so much. That's great. The challenge I've been given by some of those real ardent believers in the space is fine, invest in companies in the space, but denominate your fund in let's say an equal mix between Bitcoin and Ethereum. Be kind of all in. Which is a really interesting question as to whether or not you'd go down that path. Thank you so much, René, Colleen, Marcos. Really appreciate you joining us and being such great panelists. And
thank you.
Thank you, everybody, for joining us.
Want access to more CogX videos? Subscribe now for free at cogx.co.